If you're in Asia, Australia, we're thrilled to have tens of thousands of people join us tonight from all over the world. We are in my home. We're in the mountains in the North Country, north of a feature called French King Rock, which delineated the old border between French possessions and English possessions in New England, east of New York, during the 18th century. So up here in the North Country, lots of snow, and we know folks are tuning in from all over the world. Hopefully some of you are in some warmer climates, but we're thrilled to be with you tonight. We do have some really urgent matters to discuss, and we're going to jump right in.
You know, it's a great setting here, and we're celebrating a national holiday today, but the matter we're talking about tonight is pretty serious.
Right.
So we'll just go over a few housekeeping items, and then we'll dive right into the topic. We won't waste any of your time.
Sure.
So there's a reader question box on your screen. If you scroll down, you should see it. Please type your name in and any questions you have while Jim's talking. We're going to get to those at the end of the event, so please stick around till the very end of the event. Otherwise, I think we can jump right in and start with the great currency shock of 2016 itself. What is this shock? Why is it so important? When's it coming?
Well, as you know, Peter, our way of getting out this information and communicating with our readers and subscribers is our publication, Currency Wars Alert. So obviously currency wars and currency shocks are the name of the game. We've had two massive currency shocks in the past year. Both of them have cost investors billions of dollars or more if you're on the wrong side of the trade. But conversely, if you're on the right side of the trade, if you see it coming, there's potential for enormous profits. But they've thrown markets for a loop in both cases, and there's a third one coming. We'll explain it in detail. We'll take the mystery out of it. But the one that's coming, the one that could be any day, it could be a month or 2 months from now. We're not saying it has to be tomorrow, but it could be tomorrow. And that's really the point. Is the devaluation of the Saudi Arabian currency. The Saudi Arabian currency is the rial. A lot of people don't know about the rial. They say, hey, they make all their money in dollars, so don't they just have dollars over there? Well, the answer is they do make most of the money in dollars by selling oil, which is priced in dollars, but they have their own currency, the Saudi rial. The Saudi rial has been pegged to the dollar at 3.5 to 1, 3.5 rials for $1 for 30 years. It's one of the strongest and longest pegs, when I say peg, fixed exchange rate in the international monetary system. If that breaks, it'll be like an earthquake. The method we use in Currency Wars Alert, we call it the impact method, and it's basically a way of describing shocks in international monetary policy. And I mentioned there have been two already in the past year. The first one, go back to January 2015. Remember the revaluation of the Swiss franc against the euro. That came as a complete surprise. The Swiss franc had been pegged to the euro for a long period of time. The Swiss franc did not want their currency to get stronger. The market wanted it to get stronger against the euro, but the Swiss didn't want it. Why didn't they want a strong currency? Well, it's an export-driven economy. They have Swiss watches, Swiss chocolates, precision machinery, tourism, which is a form of export because you're basically selling something you have to offer to foreigners. All of those things argue in favor of a weak currency. You can sell more. They didn't want a strong currency. But how were they maintaining the peg? They had to buy euros. So they were selling Swiss francs, buying euros, and the market said, bring it on. It was getting to the point where the Swiss National Bank was going to own all the euros in the world. They had to buy so many euros to maintain the peg, sell so many Swiss francs, that they woke up one day and said, hey, what are we going to do with all these euros? We're going to own every bond in Europe. So they had to break the peg. These pegs are non-sustainable. Think about it. If the market agreed with you, you wouldn't need a peg. The market price would be about where you want it. If you as a government are setting a peg, you're fighting the market. If you've got a printing press like the United States, that's one thing. But most countries don't. They have finite resources, and eventually the market wins. What was the second great currency shock? August 2015, the Chinese yuan. That was another peg. They were pegged at 6.2 to the dollar. But they were losing reserves. Hundreds of billions of dollars were flying out the door. People were getting their money out of China because they could see the break coming. They could see that China was going to have to devalue to stimulate their economy or else lose all the reserves. Well, the Chinese were not going to sit there and lose $4 trillion worth of reserves. That's what was happening. By the way, they have lost $1 trillion. They've gone from $4 trillion to about $3 trillion of reserves in just about a year. You extrapolate that, and that tends to accelerate. These things are nonlinear. They accelerate over time. China could literally be broke down to its last nickel of reserves by the end of 2017. So they had to break the peg. Well, we all know what happened next. They broke the peg in August. By the end of August, our stock markets were down over 10%. It was a massive correction. Think about where you were on August 31st, 2015. Hopefully you were on vacation in some nice place, but you were also glued to the screen for Bloomberg or CNBC or Fox Business because the stock markets were crashing. That's what happened when the Chinese broke the peg. So, we all know baseball, strike one, strike two, strike three, you're out. The Swiss revaluation against the euro was the first currency shock. The Chinese yuan devaluation against the dollar was the second currency shock. The third currency shock that we can see coming is breaking the peg of the Saudi rial against the U.S. dollar. The markets are already expecting it, and that's part of the dynamic we see. When the markets are betting against you, the question is, how much do you have in reserves? Well, Saudi Arabia is opening with about $1 trillion of reserves, not nearly as much as the Chinese had. And they've already lost several hundred billion. And people say, oh, they have lots of money to defend the currency. They've got lots of dollars to defend the currency. Sure they do. But are they going to sit there and watch it all go out the door? Are they going to watch that $1 trillion of reserves drain down to 500 billion, 400 billion, 200 billion? For what? To defend the peg against the dollar? Why? What's the point of that? You're going to lose all your dollars because the market's already betting against them. So, every time these shocks happen, people go, oh, we didn't see that coming. What we're trying to explain, what we do in Currency Wars Alert, what we do with the impact method is we say we can see it coming. It's as plain as the nose on your face. But people are in denial. People have vested interests. The economists of the big banks don't want to talk about bad shocks, but we do. We're very candid with our readers, so we can see this coming a mile away.
Well, I just want to remind people that we are broadcasting live right now. We have a lot of reader questions coming in, which we're going to leave till the very end, so please keep the questions coming. And just to make sure it's working, just type in your name and say hi to us, just so we can make sure this is working on our end. I see Ross from Toronto, Derek from Cupertino. Good, so keep sending in those questions. Jim, we're going to get to the impact method, which you mentioned a little bit later, but it seems to me there's two pieces to this. There is the danger of the Saudis breaking the peg, and then the opportunity, what people can actually do about it. Can you go through each? What is the impact of the peg breaking on markets in general, and then what can readers actually do about it?
Sure, Peter. We never make claims, we never make forecasts, we never put out anything to our readers that we can't back up. So there are lots of pundits out there, whether they're newsletter writers or talking heads on TV or whatever. They'll say this is going to happen and that's going to happen. That's fine. Everyone's entitled to their opinion. But we have very sound, quantitative, scientific methods that we use to make these forecasts. So I want to talk a little bit about why we're saying the Saudis are going to break the peg. The main reason, and some analysts have said, they've been in this situation before, they defended it with their dollars, but things have changed. What's changed is that Saudi Arabia is facing an existential threat. Since the 1970s, we've had what's called the petrodollar deal, and I think a lot of our listeners are familiar with it. This was a deal worked out in the 70s by Henry Kissinger during the Nixon and Ford administrations, where basically Saudi Arabia agreed to price oil in dollars. Now, it doesn't have to be priced in dollars. It could be priced in Swiss francs, or at the time, German Deutschmarks, or today, euros, or Japanese yen. You could price it in gold. You could price it in a lot of things. But by pricing it in dollars, it forces everyone in the world to have dollars because everyone needs energy. Everyone needs oil. And if oil is priced in dollars and you need oil, then you have to have dollars. So this was a very powerful floor under the U.S. dollar and helped the dollar to maintain its strength through all these decades. Well, why change it up now? Well, the answer is that the U.S. has stabbed Saudi Arabia in the back. We always favored the Saudi Arabians, at least since 1979, vis-a-vis our enemies, Iran. Beginning in December 2013, President Obama decided to declare détente with Iran. We were in a financial war with Iran. We had them on the ropes. The president relieved them of the sanctions and went into this nuclear negotiation having to do with uranium enrichment. I don't want to get too bogged down in that, but the bottom line is that the United States has now relieved all the sanctions on Iran. We've freed up $100 billion, which Iran can use to do what? Well, they can finance terror, they can buy Russian weapon systems, they can build more nuclear plants. Saudi Arabia is sitting there looking at this. Now, what's going on in the Middle East? Iran is building a Shiite, what's called the Shiite Crescent. Remember, we think about the Muslims attacking the Western world through terrorism and jihad. That is going on. We see it with the Islamic State. But there's a fight to the death inside Islam between the Shiites and the Sunnis. The Iranians are Shiites, the Saudis are Sunnis. So they are deadly enemies. The Iranians are Persians, the Saudis are Arabians. They're on two sides of a major body of water, the Persian Gulf. The Saudis actually call it the Arabian Gulf. So you have this existential fight going on. Now the United States has chosen sides. We've sided with the Iranians. We're giving them money. So what's Saudi Arabia going to do? Well, Iran is building this alliance first with Iraq. The U.S. gave them Iraq. We had control of Iraq, but we gave it back and the Iranians took over. What's the next country over? So you go Iran, Iraq, who's next? Syria. Who's after that? Lebanon. Lebanon has the Hezbollah, that's a Shiite militia. Syria has Assad, who is backed up by Iranian Shiite forces. And of course, Iraq is practically a proxy, a client state of Iran. So they've built this arc from Iran to Iraq to Syria to Lebanon, almost from Pakistan to the Mediterranean Sea, an arc half surrounding Saudi Arabia. But it's worse than that. They've now completed the surrounding maneuver in Yemen. Yemen is not part of this arc. Yemen is south of Saudi Arabia, and the Houthi rebels are in Yemen, and Iran's backing them as well. So if you're Saudi Arabia, you're feeling encircled. Iran, Iraq, Syria, Lebanon, Yemen, and Yemen will give Iran not only control of the Straits of Hormuz, where the oil flows, which they already have, but Yemen controls the mouth of the Red Sea, which controls the Suez Canal. So they're encircling Saudi Arabia. They're controlling two major choke points in the world. They're getting $100 billion from the United States. Saudi Arabia feels that they're in a struggle for their existence. This is an existential threat. So bringing it back to economics, they're not going to sit there and let these dollars go out the door. They need the dollars to buy weapons systems, maybe to get their own nuclear weapons program from Pakistan if Iran goes too far, anti-aircraft systems, up-to-date jets, etc. So this peg is going to go. It could go tomorrow. I'm not exactly predicting that. I'm saying it's going to go soon. It could be tomorrow. It's going to be a shock. Well, this will not be confined to Saudi Arabia. This is not some little side bet if you happen to have some investments in Saudi Arabia. This is going to be felt around the world. It's going to be felt in the Middle East, in Turkey, in Europe. Everyone in the world, the Chinese broke the peg. Now the Saudis broke the peg. Will Hong Kong be next? The United States dollar ends up as the strongest currency in the world, absorbing all the deflation in the world. When you have the strong currency, you're the one who gets the deflation. That takes your economy down. This is a complete mess. We don't have time to kind of go every country in the world and talk about the implications of this. I can only tell you that you can see this break in the peg coming for the geopolitical and economic reasons I described. And when it comes, in our impact method, in Currency Wars Alert, we use what we call the snowflake and the avalanche. I worry about the avalanche. That's all the snow that's unstable. We got snow right outside the window here. The snow that's unstable, that's getting ready to crash down as an avalanche, that's what you need to worry about. That's what wipes out investors. But remember, an avalanche starts with a single snowflake. A snowflake comes down, creates a small disturbance. Pretty soon that turns into an avalanche. Well, the avalanche will be people's net worth getting wiped out in the markets, but the snowflake could be the breaking of the Saudi Arabian peg. That's what we're watching in Currency Wars Alert.
Just to recap, because we literally have thousands of people joining us in real time. We had 43,000 people sign up for this event.
Fantastic.
So some people are joining us right now, so we just want to recap. You're predicting or warning that the Saudi Arabia will break the peg between their currency, the rial,
correct,
and the U.S. dollar.
Correct.
You think that could come any day, but
Peter, it could happen tomorrow. The thing about these currency breaks, after they happen, everyone says, "Oh, we saw that coming." Well, the truth is they don't see it coming. Very few people see it coming. We see it coming in advance, but it's always a shock because right up until the moment it happens, everyone acts as if they're going to defend the peg. I'm sure if you got some Saudi economic spokesman, Saudi Arabian Monetary Authority, on television tonight, he would say, we're going to defend the peg. But that's what the Bank of England said in 1992 when George Soros broke the Bank of England. That's what the Chinese were saying right up until August. That's what people always say right up until the minute they break the peg. And then when they break the peg, everything collapses immediately. Everyone acts, we didn't see it coming. We're telling you we see it coming, and we told you why.
Well, I'm seeing readers asking questions right now. We were just talking about the snowflake and the avalanche, which plays into your overarching theme of a monetary collapse.
Right.
And we were just talking about the Saudis depegging as a potential snowflake. So someone's asking right now, should I run out and sell all of my stocks? Is this something that people should go and hide from, or is there an opportunity to invest around this, and why?
Well, there's definitely an opportunity. Look, we're in a pretty bad, borderline bear market. We've already had a stock correction. As we're sitting here Monday night, this is a live broadcast. The stock futures are indicated lower. I'm not, who knows? They're thinly traded. Things could change by tomorrow morning, and just because it opens down doesn't mean it's going to close down. So let's see what happens with the stock market. But we all know what's happened the first 2 weeks of January. And by the way, it's not really a surprise because we're heading into a recession. The Federal Reserve blundered by raising rates. They're throwing the United States into a recession. Stocks always go down before a recession. So if you think happy days are here again, then maybe you're surprised the stock market's going down. We're not, because we see a U.S. recession. I said this all fall. I said it in multiple interviews in December. So if the U.S. is heading into a recession, which we do expect based on Fed tightening, why would you tighten into weakness? It makes no sense at all. But that's what the Fed's doing. They seem to be on some kind of kamikaze mission. Therefore, you would expect stocks to go down. So yeah, I would get out of the stock market, but that doesn't mean there's nothing to do. There are certain things you can buy that will go up. You should have some cash. You should have hard assets like real estate and gold. Don't go overboard. I recommend 10% gold. But there are things in the securities markets, in currency markets, that you can do to make money when these shocks come.
Well, I'm sure most of the people watching right now have read your books, so they're aware of your more permanent portfolio of cash, bonds, gold.
Right.
But let's get into something specific. We've identified this opportunity. The Saudis are going to depeg.
Right.
There's going to be a sudden movement in the markets.
Right.
You can tell that it's going to happen, but you can't tell when, so we should prepare. What do we do about it?
Well, there is a very specific trade that we're recommending in Currency Wars Alert. By the way, Peter's right. I think the viewers can see I don't live in a cave. I wake up every morning. I go to work. I invest. I think there's things to do. I'm not hiding out with guns and ammo and canned goods. I agree completely that investors need to get out there and make the most of it. So how can you profit? How can you make some money from the shock that we've described, which we talked about, which is Saudi Arabia breaking the peg to the dollar? Well, unfortunately for the readers, for everyday Americans and people around the world, Canadians and our visitors from around the world, there's no particular instrument. There's no Saudi stock index that's liquid enough for our purposes. There are a couple of securities like it, but you can't go directly into Saudi Arabia. But there are very good proxies. We've identified a Turkish ETF. Basically, it's an exchange-traded fund that tracks the Turkish stock market. There is a liquid market on puts, so we're recommending readers buy puts on that Turkish stock market index. Because if Saudi breaks the peg, the rest of the world's going to be worse.
Can I
Turkey's
butt
going
in
to be
1
worse.
second?
Sure.
I want to make sure everybody's on the same page as us. So we just said a lot there. Buy put options on a Turkish ETF.
Correct.
Let's just back up and talk to the reader who's a new investor or who has never touched options before, because I feel like they can be very scary. What is, very basically, what is an option, first off?
So an option is a type of security. It's a contract, but it's a security. You can buy it and sell it just like a share of stock. So you can buy a share of IBM or General Electric, and you can buy an option on IBM or General Electric. So it's just another security that you can trade in your regular securities account. But there are two types of options. There are puts and there are calls, and there are two types of trades, buying and selling. Some of these are much riskier than others. We're recommending what we view as the least risky option. First of all, we're recommending to investors that they buy option. An option is the right to buy or sell a security at a fixed price, but not the obligation. You don't have to go ahead and exercise the option. But of course, if it's in the money, you will. So, very simple example. Let's say a stock is trading at $30 a share. You spend $2 for a call option, so you get to buy that stock at, say, $35 a share. So it's trading at 30. You have the right to buy it at 35. Would you go ahead and do that? No, you wouldn't do that because it's selling at 30 in the market. But what if that stock goes to 40 or 45 or 50? Well, you're sitting there with the right to buy it at 35. So when that stock hits 45, you've got the right to buy it at 35. You've made $10 a share. Remember, you only paid $2 for the option. So you made 5 times your money. You made 500% on your money. So simply put, an option is the right to buy or sell a stock at a fixed price. You may or may not exercise it depending on what the stock actually does. But if that goes in the money, you could make multiples, 200, 300, 400% profit. Now, there's risk, of course. What if the stock goes the other way? Well, then you're going to leave your $2 on the table. So you could lose your option premium. Just want to be very clear about that. But you could make multiples of it if we get the direction right. And of course, that's what we do at Currency Wars Alert. We try to analyze these trades so our readers can make money. Now, I said before you could buy an option or sell an option. We only recommend buying options. Some people like to sell options. That's fine for them. It's not what we recommend to our readers. The problem with selling options is you have unlimited risk of loss. You're the one who's given somebody else the right to buy your stock at a certain price. And if that goes against you, you could lose all the value of that stock and more. So we don't recommend selling options. When you sell an option, you're basically saying there's not going to be much volatility. I'll get news for everyone. There's a ton of volatility in the world, and it's getting worse. By the way options are priced is a very technical mathematical formula called Black-Scholes, named after two finance experts, Fisher Black and Myron Scholes. I was partners for 6 years with Myron Scholes. We shared offices all that time. I had the privilege of many, many hours of conversation, private tutoring, if you want to think of it that way, by Myron Scholes, who won the Nobel Prize in economics for the Black-Scholes formula, which is how they price options. Myron's a great guy, but there are serious, serious flaws in his formula. We've identified those, and we take advantage of those for the readers. One of them is that the formula expects what's called continuous price movement. So if a stock's going from 20 to 30, it assumes it'll go, 20, $20.50, 21, 22, 23, 24. That's how prices are going to move. In the real world, that's not how they move. They gap. They go from 20 to 30 all at once. So the problem is if you're not in the trade and the shock happens and it gaps up, you've missed the opportunity. So that's why we're warning readers now. We're saying we see the Saudi Riyal devaluation coming. The time to get in on it is now. The way to make the most money, the most bang for your buck, is options, because as we described, you can make 200, 300, 400% on your money. And we want to be a buyer, not a seller. We don't want to bet that things are going to be calm. We want to make the bet that things are going to snap. And that's the opportunity we're talking about.
Jim, we are focusing on what we're calling the great currency shock of 2016,
right?
This Saudi depegging.
Right.
But I mean, is it game over after this happens? If you're right and the Saudis do depeg, is this the end of these opportunities? It sounds like you're saying that the market is extremely volatile right now, and that this move will make it a little bit more volatile. Are we expecting more volatility, more shocks like this, or after this, will that be it?
Definitely more, Peter. And this goes back to my book, Currency Wars. If you pick up the newspapers today or go online or look at financial websites, what do you hear about? Currency wars, currency wars. That's what the Chinese devaluation is about. And the Chinese are going to devalue more. That's what the Saudi devaluation is going to be about. And you'll see other devaluations coming. We talked about Turkey. That's where we want to place our bet, because that's a liquid market. But I wrote that book. That book came out in 2011. And of course, you don't write a book in one day. I actually wrote most of it in 2010. The book was published in 2011. This is 2016. How did I know 5 years ago that we would be talking about currency wars today? Well, the answer is that we were in a currency war then. This is the same currency war. Financial writers wake up and they say, oh, there's a currency war today. And I just shrug and say, no, it's the same currency war. It's been going on for 5 years. And one of the points I made in my book is that I looked at two prior currency wars in history, what I call Currency War I, which went from 1921 to 1936, and Currency War II, which went from 1967 to 1987. One was 15 years, one was 20 years. This currency war is about 5 years old. I expect it to go on for another 10 or maybe 15 years. They always do, because they don't have a logical ending. So to answer your question, Peter, we see an opportunity today, but there's going to be one opportunity after the other for years to come. That's why we published Currency Wars Alert. Currency Wars Alert started about a year ago. We've had great success in the years since. We come out every other week with a specific recommendation. We use a proprietary method. We're getting very good results. We think there'll be lots of trades like this in the months and months ahead.
Well, before we get into any kind of recommendation, why don't we just talk about your method a little bit in Currency Wars Alert?
Sure.
So you've called it the impact system.
Right.
What's so special about it, and why should readers pay attention to what it's telling them?
Well, what's special about it, it's based on a model. The model is called complexity theory. Now, a lot of people, they hear the word model and they roll their eyes. They're like, oh, models are a bunch of junk. But they're not. There are bad models and good models. So the key is to get the model right. So there's a real world out there. It functions in a certain way. So a model is nothing more than a mathematical representation of the real world. You try to come up with ways of describing real world behavior with equations so that you can plug in data and get certain results. Now, the problem is the Federal Reserve uses the wrong models. They've got obsolete models called equilibrium models, and the idea there is that, you know, the world's like a Swiss watch or a clock, and it runs fine, but it gets out of equilibrium, so you apply a policy and you push it back into equilibrium, and it's all good. That's not the way the world works. The world is actually a complex system. A complex system can run fine for a while also, but suddenly something disturbs it. This goes back to our snowflake and avalanche description. Something disturbs it, and you can't just push it back into normal. It can actually go wild. It's like a nuclear reactor. The Fed thinks they're playing with a thermostat. You know, the house is too cool and you dial it up. The house is too warm and you dial it down. But they're actually playing with a nuclear reactor. You can dial a nuclear reactor up or down, but if you get it wrong, you're going to have a catastrophic meltdown. That's an example of a complex system in action. So we understand capital markets are not equilibrium systems, they're complex systems. So then how do you understand, how do you model a complex system? Well, we know what can go wrong, but we have to look for what we call indications and warnings. Another way to describe it is the snowflake and the avalanche. You can see the avalanche coming, but we're looking for individual snowflakes that could trigger that. So these are the things we look for, and we see a whole bunch of them right now, and that's why we're issuing this alert. So I already talked about Saudi Arabia. I talked about the threat from Iran, the need to conserve dollars for military spending, the Iranians firing a missile at a U.S. vessel, the Iranians taking U.S. sailors hostages and forcing them on their knees. Yes, thank goodness they were released the next day, but it was still a humiliation for the U.S. Navy. Iran surrounding Saudi Arabia. These are all snowflakes. No one of them has caused a market meltdown, but the market's already unstable. We see these indications and warnings coming. We talked a little bit about Turkey. We said our specific play is in Turkey. That's the recommendation we're making. What's going on in Turkey? I've been to Turkey a number of times. I actually spoke to a senior central bank official there. She told me that the Turkish government is not the least bit reluctant to put pressure on the central bank, so that it's easy to see that they were going to cut interest rates and devalue the currency. Believe me, if Saudi breaks the peg, Turkey will get on even faster. They have to. But Turkey's under enormous stress. You've got refugees coming in from Syria. You've got the Islamic State launching attacks. You've got Kurdistan looking for independence. You've got Russia, a neighbor right across the Black Sea. Remember, Turkey shot down a Russian fighter bomber just a few weeks ago in November. Russia is now seeking retaliation. And Putin's a believer in the old saying, revenge is a dish best served cold. And what that means is you don't come out and get your vengeance the next day. You wait a while and you hit the guy when he doesn't see it coming. So Putin will whack Turkey when the time comes. So Turkey's got enough problems as it is, but when you join it to Saudi Arabia and the likelihood of the Saudi Arabia depegging the currency, you can see a catastrophe coming in Turkey. So this is our method, not to look at any one headline, but to understand the system is complex, understand the instability, look for these individual indications and warnings, and when enough of them pile up, you can see the avalanche coming.
So I know it's a little tedious, but again, we have to be considerate to everybody who's joining us while we're talking. This is
Sure.
live, so people are joining us in the middle.
Yep.
Let's just recap a little bit and then go right back into a few reader questions that I'm seeing.
Good.
You're predicting that the Saudis, Saudi Arabia, could depeg their currency, the rial, from the dollar any day now.
Correct.
That's going to have a massive impact on the markets.
Yes.
Maybe even compound some of the recession dynamics we're seeing and send U.S. stocks lower.
Sure.
But that you shouldn't stock up on canned foods or
No, there's always
go in the
something to do.
basement.
There's always ways to make money. Absolutely.
And you recommend options, and in particular,
We recommend buying options. We don't want to sell them because when you sell an option, you're betting that things are going to be normal.
Right.
We're not making that bet. When you buy an option, you're saying things are going to go crazy and things are going to be extreme, and that's what we're seeing in the world.
I see we have Brian from Denver, who's a Currency Wars alert reader, and he was saying that he likes the way that you explain the options in the service, so he's thanking you.
Thank you, Brian.
You do make it pretty simple for people to understand. I know I didn't trade options before I started working with you. In fact, I was a little leery of them because I had always heard they were very risky or they were a way to lose your shirt. And it's really only a certain type of options trading, selling options.
Selling options is extremely risky. Buying options, you actually limit the risk. When you buy an option, you spend a certain amount of money for it. Now, we're only recommending buying an option when our impact method is telling us we have a very strong potential for very large gains, 200, 300, 400%. But it's not infallible. you could lose some money, but how much could you lose? You can only lose what you pay for the option. So you pay X for the option. In a worst case, you could lose X, but you're not going to lose more than that. But if you sell an option, you have unlimited risk of loss, because if you sell an option, if you sell a call option, and that stock goes up and up and up and up and up, you're going to lose all that difference. You're going to get called away and lose all the profit on that stock. And a lot of Wall Street analysts recommend selling options. They say, hey, what could go wrong, right? You own your securities, so sell options on them, collect the premium. It's money in the bank. It's like free money, and you still own the stock. That's what Wall Street tells you. But it's completely false, because it assumes that the price isn't going to change. It assumes that everything's normal, everything's fine. It's not. We've seen one catastrophe after another, and don't ever sell an option, what's called a naked short. That's when you sell an option and you don't own the stock. Even if you own the stock, you're going to get called away and lose all that profit. But if you don't own the stock and you sell an option and that goes up, you're going to have to cover at a much higher price, and you could lose a fortune. So we never recommend selling. We do recommend buying. We only recommend buying when our impact method is telling us we have a very high probability of success. And from an investor's perspective, you have unlimited gains and limited losses. We like those kinds of trades.
We'll talk about that a little bit. I wrote these down before we started because they're impressive numbers. So in your open portfolio in Currency Wars Alert, the big winners, you got 123% winner. That's an open position right now. 64% winner, 78% winner. These are all paper gains. Of course, we haven't taken any gains on those, but we have taken some gains. Last week we took two big gains. One on, I think it was puts on Goldman Sachs, and the other was a Frontiers Market ETF. So both of those doubled readers' money, and I'd say it was under 6 months almost.
Oh, way under 6 months.
Way under 6
absolutely,
months,
yeah. So we almost doubled the money on each trade in a very short period of time. Absolutely.
And I think I know your answer, but are there more or fewer of those coming?
There are definitely more coming, Peter, and it has to do with these flaws, these mathematical, intellectual flaws in the Black-Scholes model. When you're an options specialist, or you're on the floor of the Chicago Board Options Exchange, or you're an over-the-counter option market maker, they have a method for pricing the options. The method is Black-Scholes. Again, my friend Myron Scholes won the Nobel Prize for helping to devise this method, but I spent 6 years sharing an office with him. I've studied risk management for 15 years, and I've identified, not the only one, some other people have identified it, but we've identified the flaws in Black-Scholes, and there are two. Number one, Black-Scholes underestimates what some people call black swans. We call them avalanches under the impact method, but Black-Scholes underestimates these shocks that happen all the time. It assumes that they don't happen, but of course they do. The second flaw in Black-Scholes is it says, okay, when new information comes along, and it could be a shock of the kind we're describing, that prices adjust in a continuous way. You get all those intermediate points. So from here to here, you get to transact, buy or sell here, 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 here. That's not the way the world works. The world goes from here to here in a heartbeat, just like that. If you're in the trade, you make all that money. If you're not in the trade, you could lose all that money or at least miss the opportunity. So we've identified those flaws. That's why we want to buy options, not sell them, because when you buy it, you own the tail. When the crazy thing happens, you benefit, you win.
Let's take a couple of reader questions here real quick. We are live, so people are saying, can I just benefit from buying certain ETFs? What about playing the Saudi Real on its own? Well, let's talk about that for a second. What are some things readers might do given the headline of this event? It's called the Great Currency Shock, and we've now revealed that we're talking about the Saudi Real being depegged.
Correct.
I'm not the expert you are, but a couple things come to my mind. I could play an ETF, just go long an ETF.
Right.
I could short an ETF.
Correct.
I could actually try to get into the Forex market, the foreign exchange, the currency markets.
Right.
Why invest in options like you're talking about instead of some of these more common or maybe intuitive methods?
Well, I mean, you're right, Peter. There are other ways to play it. I don't dispute that, but we want to come up with the safest way for readers. So you say, the first question we always ask yourself, we don't make any recommendations where we haven't used the impact method, used indications and warnings, used our models, and we feel there's a very high probability that we're right. But we could be wrong. Sometimes we get them wrong. Well, if you short something and we're wrong and it goes up, you could lose unlimited amounts of money. But when you buy an option, if we're wrong, you can only lose the amount that you paid for the option. You cannot lose more than that. So you could make, again, 2, 3, 4, 500%. That's easy to see. You could lose, but you'll only lose the amount that you pay. When you short something, you have an unlimited risk of loss. So of course we want to go for the upside. Of course we want to give recommendations to readers that make money, but we don't want readers to get wiped out either. And that's one of the reasons we recommend buying options. As far as the currency markets are concerned, the currency markets, I've been a banker for 30 years, over 30 years. The currency market is an institutional market. Big banks and big institutions trade trillions of dollars equivalent of currencies every day. It's a very deep liquid market, but it's only for large institutions. The retail investor, the everyday American, does not get to play in the currency market. Now, there are some retail brokers out there who are offering Forex trading. I see the commercials on TV like everyone else. Mm-hmm. You get the worst rates, the biggest bid offers, the highest commissions. It's not a good deal for investors. The other thing you don't get is leverage. Now, the great thing about buying an option, again, we can be right or wrong. We work very hard to be right. We've had some big winners for readers, as you described. But options do have leverage. If you just make a straight-up bet, you buy the currency and it devalues 10%, you made 10%. If you buy the put option and it devalues 10%, you could make 2 or 3 or 400%. That's the beauty of options. So you have limited downside and very high upside with embedded leverage. But better yet, you don't have to use borrowed money. The leverage is built into the option. The leverage is built into the option. So you could lose a little, you can make a lot, but either way, you're not going to have to borrow money and you're not going to have unlimited risk of loss, which you do have if you short the ETF. And as far as the currency markets are concerned, you can make money, but there's no leverage. So we're trying to come up with that sweet spot where you can make a lot of money, limited downside, very easy to trade, and you get a good deal, because in the Forex market, you're not going to get a good deal. That's for the big guys.
The Forex market's also pretty complicated relative to buying options, as you put it.
Sure. I mean, you could call your broker, your wealth manager, whether you're at Morgan Stanley or Merrill Lynch or Goldman Sachs or Schwab or Ameritrade or any of these brokers. They'll understand options. Any registered rep with a Series 7 or Series 24, these are the tests you have to take to have a license to transact for customers. They'll know exactly what an option is. They might not know anything about foreign exchange. I mean, we're doing the analysis on foreign exchange and coming up with a trade for investors, but it's a very simple trade that your broker will know how to execute. If you call up your broker and say, I'd like to do a Saudi Riyal US dollar cross rate forward, he'll have no idea what you're talking about.
Yeah. Well, I want to take Tom's question here, because you started talking about a specific investment having to do with Turkey as the best way to play this.
Right.
And obviously we make these recommendations to readers, so we don't want to shortchange them and give away the specific ticker, but we do want to let everybody here on the call access this trade in a risk-free manner.
Sure.
So we're going to explain how to do that in a second. But Tom asks, given that many people, he's from Newport Beach, he's asking, given that many people are viewing this program today, won't everybody buying this put recommendation drive the price whichever way?
Well, it's a good question, but that's why we picked a liquid instrument. We didn't want to. We actually worked hard. We have a research associate, senior research associate, Dan Amos. We work on these ideas together. We work with you. We work with Dan. We don't just, it's hard to come up with the right idea. Then you have to analyze it. Then you have to use the impact method and use these indications and warnings I described. But if you get that far, you still have to say, well, what instrument is the best way to trade it? And we only pick ones that are relatively liquid. Look, there are a lot of people on the other side of the trade. There are buyers and sellers. So there could be some market impact, but we'll have less market impact by picking a liquid instrument, which is how we settled on Turkey. It's a big country. It's a big market. That ETF is liquid. We have a very specific way to trade it that we're recommending to our readers and our subscribers. And the answer to the gentleman's question is we pick liquid instruments for that reason, so we don't have too much market impact.
I want to get back to reader questions, but let's invite readers to join us, because
Sure.
I think this is a pretty big opportunity.
Sure.
So you have been working on a new report. It's the same title as this event, The Great Currency Shock of 2016.
Right.
In there, you're outlining this play as you see it unfolding,
Mm-hmm.
and the specific recommendation having to do with Turkey that you believe is the essential play.
Correct.
Without giving the ETF away and the exact put option information away, why is this essential for readers to know right now?
Because this break in the peg could happen tomorrow. That's the thing. It might not happen tomorrow. It might happen 6 months from now. It might happen two months from now. But it could happen tomorrow. That's the nature of these currency shocks. You can see them coming analytically. People talk about them. You can find articles here and there. But who actually believes it's going to happen? I read an article this morning that said, oh yeah, we know the Saudi rial is under a lot of pressure, but they've got $1 trillion to defend the currency. Well, that's what the Bank of England said when George Soros attacked them. Now, George Soros looked at the Bank of England. This is 1992. It's still called Black Monday in UK financial history. It was the day that George Soros broke the Bank of England. But how did he do it? Well, he knew that for the Bank of England to defend the peg between sterling and dollars, when there was a lot of selling pressure on sterling, what did they have to do? They had to buy sterling and use the dollars to do it. So they're buying sterling, they're paying dollars, they're paying dollars. George Soros says, I've got more sterling than you have dollars. I can borrow sterling. I can get lines of credit. I can get hedge funds to join me. I can get banks to join me. We will sell sterling until you're blue in the face, and we will suck you dry. We will take every dollar you have, and we will break the Bank of England. Soros figured that out, and they got like halfway through it, and the Bank of England said, you're right, these guys keep coming. They're taking our last dollar. So the UK, the Bank of England, was not going to sit there and let their last dollar walk out the door, and so they broke the peg. And that was a shock. George Soros, by the way, made $1 billion that day. $1 billion. Now, flash forward, 25 years, 23 years, Saudi Arabia is in the same situation. In fact, China was in the same situation. They still are. So your currency is under attack. People say, hey, I want to sell reals and take dollars, sell reals and take dollars. So you're the Saudi Arabian Monetary Authority, that's the name of their central bank. The dollars are going out the door. You have to give the dollars to all the people who want to sell you reals. At what point will you break the peg? At what point will the last dollar walk out the door? They can't afford for the last dollar to leave. Why? Because they have to buy weapon systems. They have to buy nuclear reactors. They have to buy possibly nuclear weapons from Pakistan. They have to finance the war against the Houthi rebels. They have to finance the war against Assad in Syria. They're being strangled by Iran and stabbed in the back by the United States. You think they're going to let their last dollar go out the door? Of course they're not. So we can see these things coming. But could it happen tomorrow? It could, and that's the urgency of this.
So let's just invite readers to join us. We have a report called The Great Currency Shock of 2016. It outlines the specific ETF. Mm-hmm. We were just going through it before this call. It's an attractive opportunity. The pick you've made, it could rise as much as 300% by the time this happens. Right. And this could happen tomorrow. It could happen next week. Will readers make 300% if they wait for this to pop and get in an hour after they hear the news, 2 after? Do they absolutely have to be positioned beforehand? They
do, because as I said, when these things break, they could break any day, but they break very quickly and very suddenly. So if you're not in this trade, it's not like you're going to wake up one day and log on and look at the internet and say Saudi is breaking the peg. Oh, gee, I think I'll get in on that trade. That trade will be over. It'll be a shock. But the other thing, Peter, about Currency Wars Alert, we do have this specific recommendation out there that we hope readers have a look at, and you need to do that immediately. But there's one after the other. We've had a whole series of them. Some of them have done extremely well. We actually have more in the pipeline. Yeah. We're already working, a couple issues ahead, thinking about what's next. This is not a one-trick pony. This is our urgent recommendation right now, but we've got more to come.
All right, we've done something we haven't done before because we think this is so urgent. Mm-hmm. All right, usually, we sell Currency Wars Alert for $2,000, sometimes even more per year. Right. So that's just 12 months. And today we want to invite you to take a risk-free trial of Currency Wars Alert. About this time, a button should have popped up on your page. And when you click it, you'll be taken to an order form that will outline all the details. And we're doing this only for tonight. But we'd like to invite you to sign up to get this report that we've put together for you. Mm-hmm. Read it. Look at the pick that Jim's made. See if it's for you. We usually sell Currency Wars Alert for about $2,000 per year, and tonight we're doing something very special. We're going to offer 14 months, so 2 extra months at $1,750. Now I know that sounds like a lot, but with the expertise you're giving in the service, the amount people can make on this pick alone, 300%, you can make that money back pretty quick. And you've often told me something about fees you'd pay for professional money management versus what we pay for.
Sure. Just look at what professional research people do. You pay $22,000 a year for the Bloomberg service. Yeah. You pay $25,000 a year for something called capital economics. You pay your wealth manager 1%. So if you have 1%, if you have $5 million with a wealth manager at 1%, that's $50,000 a year that you're paying your wealth manager. That's assuming he can make money, and a lot of them can't. So, for $1,750 or $1,750 $50, actually for more than a year, 14 months. This is very inexpensive relative to all the alternatives, and we get very good results. So we're the ones paying all these other larger amounts to get all these inputs. But it's not just that. We have proprietary methods. We have my 35 years of experience in commercial banking, investment banking, hedge funds, risk management, intelligence work for the CIA and the Department of Defense. We take two worlds, think of it as a Venn diagram, the world of capital markets, stocks, bonds, commodities, currencies, derivatives, and the world of geopolitics, diplomacy, intelligence, military affairs, etc. Where they come together, that's our expertise. They used to be pretty separate. There's always been some connection, but now that merger of the two is getting greater and greater. You cannot understand what's going on in European markets or world markets without thinking about, what's the reaction to Putin taking over Crimea, invading eastern Ukraine, the Iranian deal with the United States, what's going on in the Persian Gulf, what's going on with ISIS. If you can't take all these factors into account, you're going to miss one investment opportunity after another. There's a matchup. It's what we do. I love writing it. We put heart and soul into it. We're always coming up with new ideas. This is a long-term relationship. We're not saying, pay a certain amount of money for one issue or one idea. You can make all your money back on one idea. That's easy. But we're going to have idea after idea every 2 weeks for your 14-month subscription, hopefully long beyond that. So we think this is a great deal.
Well, let's talk about what they get exactly.
Sure.
We do a recommendation every other week.
Correct.
And that is a specific recommendation that could make at least double your money.
Sure.
Every other week.
Right. Certainly pay for your subscription
Yeah.
easily, many times over.
Right.
Many times over.
So one recommendation that could easily pay for your subscription.
Correct.
And that comes every other week.
Correct.
So we're looking at about 24 recommendations a year.
That's right.
And on top of it, you've also put together a great handbook called the Currency Wars Trader Handbook, and that explains everything. It's a soup to nuts explanation of what options are, how to execute them, it's a mock walkthrough about how to actually execute the options trade in a brokerage account. You also have the Great Currency Shock report that explains this Saudi depegging event,
Right.
why you think it's so important, and what the specific recommendation is that could make 300 times readers' money.
Yeah, Peter, one question I get a lot, and I travel around the world, and I'm on 5 continents, and I appear at a lot of financial seminars and do a lot of media, so I just have a lot of opportunity to talk to people around the world, and people have said to me, well, Jim, why are you doing this? What motivates you? I mean, what gets you going? And going back to my books, the newsletter, Currency Wars Alert, other newsletter products we have, the thing that motivates me the most is I just got sick and tired of watching everyday Americans get picked off by basically the financial elites. Jamie Dimon always comes up a winner. George Soros always comes up a winner. It's always the everyday American who gets ripped off either by inflation or they get suckered into the stock market by Wall Street. If you have a medical problem, you don't think you have to go to medical school. You call your doctor because you trust your doctor. If you have a legal problem, you don't think you have to go to law school. You call your lawyer because you trust your lawyer. But if you have a financial problem, and believe me, not having money is a problem, but having money is a problem. Having money is just as much of a problem because you're worried about losing the money, or how do you make money to pay for kids' college tuition or a second home or your retirement. So either way, having money is just as much of a problem. It would be nice if you could trust your Wall Street professional the way you trust your doctor or your lawyer. Unfortunately, you can't. I've been in this business too long. Wall Street is designed to separate you from your money. Wall Street has a complete conflict of interest. They will throw ideas at you, and you'll wake up, and every 7 years, half your money will be gone because the stock market's going down. I don't mean just going down a little. I mean crashing. It's happening right now. When people say, "Oh well, it'll come back the next day," and it doesn't, or buy the dips and it goes down more. They listen to all this stuff on financial television. Next thing you know, they're down 30, 40%. They're like, what happened? If we're in a bear market, and it does look like a bear market because we're heading into a recession, bear markets don't go down 10% or 20%. Bear markets go down 50%, 60%, 70%. That's typical of a bear market. Imagine the S&P at 600 or 700. Imagine the Dow Jones at 9,000 instead of 16,000. That's what we're talking about. That's the kind of wipeout we're talking about. I just got sick of seeing it happen every 7 years. You talk to people like Warren Buffett and George Soros, they'll tell you, making money is great, but the way you get wealthy is by not losing money. Because when you go in the hole, you could spend 5, 10 years, 15 years crawling out of the hole, and where have you been for 15 years? Even you didn't make anything because you lost it and you made it back. You know, the making it back feels good, but the losing it doesn't feel good. We're trying to avoid those losses in the first place, and that's why we offer the service.
I want to get to reader questions, but I just want to summarize. We want to not only invite readers into Currency Wars Alert to become subscribers. We want to build a long-term relationship with them.
Absolutely.
This isn't a one-time deal. The opportunity to invest in the Saudi depegging is a one-time deal.
Right.
So either you're in or you're out on that.
And this low subscription price is a one-time deal, but it's usually more expensive. But we hope people do sign up, do take the subscription, and become we have a long-term relationship with the readers. Absolutely.
Well, when we were talking before, we decided to extend something else today. So not only is it a discounted price, almost 40% off, I guess, at $1,750.
That's a good deal.
But we're giving them 2 extra months, so 14 months for that price instead of just a year. And then on top of it, we're going to do 2 months, which is risk-free. So we're going to send you the report tonight. We're going to send you the first 4 alerts, the new alerts, the new recommendations you put out.
Right.
And you, the viewer, just take them in, read them, see if this is all it's cracked up to be, everything we're talking about. And if you like it, we expect you will like it, stick with us. We're glad to have you as a reader, as a customer. And if you don't like it, call up our team and simply cancel. We are going to keep a 10% holding fee, but I feel like that's fair because we do get pirates that come on and they'll take your trade.
They steal the ideas and cancel and walk away. Yeah, that's a fair gate.
So I think that's a pretty fair shake, and we'd like to invite you to click the button on your screen right now. We're going to get to reader questions in just a second, but please click the button that's on your screen. If you don't see a button on your screen right now, refresh your browser, and you should see a button pop up on the screen. Click it. It will take you to an order form page, which will have all the details, very transparent details about what we're talking about. We do hope that you become a subscriber now. If you prefer to speak with someone, we have a whole team. We're in the mountains of the Northeast right now, but back in Baltimore, where the home base is, we have a whole team standing by the phones right now. There should be a number on your screen, but if you don't see it, the number is 866-361-7662. So please give them a call also because they're standing by and they want to speak with you more about this opportunity. But Jim, let's get to some reader questions real quick. Let's see what we got here. A lot of people were wondering what the impact on oil is going to be when the Saudis depeg.
Well, by itself, there won't be much impact on oil because oil is priced in dollars. Now, we all know what's happened to the dollar price of oil. It's going down. But this could actually cause Saudi to pump more, and I'll explain why, because it's going to take a lot of pressure off of them. See, Saudi Arabia, they make money in dollars by selling oil, but 50% of the people in the Kingdom of Saudi Arabia work for the government. They don't get paid in dollars. They get paid in riyals. So right now there's a peg between the two. You take in a certain amount of dollars and you pay a certain amount of riyals. And Saudi Arabia is running fiscal deficits, and they're losing a lot of money. But if they depeg, they should be taking in just as many dollars because it doesn't directly affect the oil. But the amount that they have to pay is a lot less. It's worth a lot less because they devalue the currency. So I'm still paying my workers the same amount of riyals, but they're not worth as much. I get more riyals for my dollars, so to speak. That'll take some of the fiscal pressure off of Saudi Arabia. That'll stop the drain on their reserves. And that might make them a little more willing to maintain a low price of oil. So that would be one more reason why oil will not come back very quickly.
And we should point out that we kind of treat oil as a currency in Currency Wars Alert, right?
In fact, yeah. It's a hard asset, yeah.
Yeah, and so with every single one of these trades, I know we were just talking about the impact being negligible on oil once they depeg, but take the flip side of this trade, the dollar becoming stronger.
Right.
You've often talked about how there's 2 sides to every trade.
That's a killer. That's a killer. The strong dollar is killing the U.S. economy. Look, Janet Yellen and the Federal Reserve say that what they want is inflation. That's not a secret. They say we want 2% inflation. They haven't been able to get it for 6 years, but they say they want 2% inflation. Well, the problem is they're raising interest rates. When you raise interest rates, you make the dollar stronger. A strong dollar is deflationary, but the Fed says they want inflation. How does that work? The answer is it doesn't work. It makes no sense. This is the most misguided policy. This is why I said, and why is the Fed tightening into weakness? The U.S. economy is falling apart.
Right.
Every single, industrial production, world trade, shipping, various indices, the stock market, they're all signaling recession. So why is the Fed tightening? This is a kamikaze mission, and the strong dollar only makes it worse.
Yeah, the strong dollar is one of our open trades right now.
Correct. Yeah.
So we've been profiting off of that as well.
Yeah.
So let's take a few more reader questions. And while I'm scrolling through these, again, I want to encourage you to check out the button on your screen right now. Click it. Look at the order form. Like I said, this is a one-time offer. We're pulling this down tonight. You'll never see the price again or the guarantee we're making. So we've already answered that. Let's see here. Is this going to impact the price of gold in any way? I know we have a lot of gold investors, and that's been down.
Sure, gold's interesting. The dollar price of gold, we all know it's come down a lot since 2011. That's just the inverse of the strong dollar. To me, when I look at the dollar price of gold, I don't think of gold as coming down. I think as the dollar going up. In other words, you get more gold for your dollars, i.e. a lower dollar price of gold. But the dollar is strong against everything. So what else has come down? Iron ore, copper, wheat, the Australian dollar, the Canadian dollar, the Chinese currency. We think next the Saudi Riyal. Gold, everything's going down against the dollar. This is the age of King Dollar. But the problem is it's killing the U.S. economy. So what's going to get the dollar price of gold to go up? What's going to happen is that the Fed is throwing the U.S. economy into a recession. The Fed will be the last to know. We know it now. We've told readers about this. Other people have seen it, but the Fed will be the last to know. Why are they the last to know? Because they don't look at reality; they look at models,
right?
And their models are obsolete. We already explained.
Well, this was two alerts ago, I guess.
Right.
In Currency Wars alert, we talked about, or maybe it was a little bit further back than that. But we have a gold trade open right now.
Sure.
But if I'm understanding you right, all the currencies you listed and this dynamic. All right, we have a strong dollar now.
Right.
If that reverses, just all the more opportunities for currency.
When things listen, nothing goes on indefinitely. When things get bad enough, they reverse. So we're watching the dollar get stronger and stronger. I'm actually surprised gold hasn't gone down more. I mean, the real question is why isn't gold 850 or 900? Why is it hanging in there at 1100? That's because of physical demand. The Chinese are buying thousands of tons. The Russians are buying hundreds of tons. Everyday people around the world are buying. The physical gold is actually disappearing. One of the reasons I like gold is because when it really does start to go up and you want it, you may not be able to get it.
Right.
So the time to get in gold now, it looks like a very good entry point. Gold has actually outperformed other hard assets that have gone down even more. But once the Fed gets the wake-up call, which I think will be probably in the late summer, and the U.S. economy is in awful shape, and they have to go to new kinds of easing, could be QE4, could be forward guidance, could be interest rate cuts at that point. I do expect them, I call it the year of the boomerang. When that happens, the price of gold is going to soar because they'll be saying, hey, we have to get inflation. We have to get inflation, and then there's going to be a flight to gold. Right.
Well, Jackie from Orange is asking, most currencies outside of the euro and the United States are falling knives. Are falling knives.
Right.
I guess she's asking two questions,
but in the next 6 months.
Where would they peg it in the next 6 months?
Well, the thing is, once you break a peg, you're not pegged. The euro's not pegged to the dollar. The euro, I expect the euro to get stronger. Actually, it came way down from 160 to 140, 120, 105. When it was 105, everyone was screaming it's going to go to par. I was one of the ones who said no, it's not going to par. It's bounced off of 105 twice. Look, here's the thing: currencies are easy to understand. It's a zero-sum game. If one currency is going up, the other one has to go down. And if this one comes down, it has to go up. So people look at the euro in isolation as if, how can you talk about the euro without talking about the dollar? So for now, we have a strong dollar. But the strong dollar is killing the U.S. economy. It's just a matter of time before we have a weak dollar, which means the euro is going to go back up again.
These are two ways to play the same dynamic.
Sure.
Essentially.
It's like a seesaw. It's connected, so if one's up, the other one's down, but they can't get unconnected.
We've made recommendations based on the seesaw dynamic for a lot of currencies for over a year now. We've been doing this in Currency Wars Alert.
Right.
So when you take the risk-free trial tonight, which again, to do that, you click the button or you call the number on your screen, and you want to do that now because we're going to pull this sooner rather than later. We're really doing this because of the one-time opportunity with the Saudis depegging soon.
Right.
So please click that button. But when you do that, you're not only going to get the bi-weekly alerts that come out. The next one will be out 2 weeks from now. Mm-hmm. You'll not only get the report outlining the specific play Jim thinks you could use to make 300% when the Saudis depeg, You'll not only get the Currency Wars Trader Handbook, but you also get the full archives. People can look back.
Sure, the old issues, yeah.
And these trades are, I mean, give or take. I mean, some of the prices may have changed. They may have been out of our buying range.
Right.
But these are long-term options. Some of these trades are still good.
That's right, Peter. And some of the nicest compliments I get from readers, people say, "Look, I get the Currency Wars alert. I act on some of them. You don't have to act on every trade. We're giving you advice. We're giving you recommendations. You can choose to act on them or not." But we've had readers who said, "You know what? Sometimes I act on them, sometimes I don't. But I love every issue. I love just the information, the analysis you give. It makes me a smarter investor. Sometimes I can take your analysis and use it somewhere else." And we welcome that. We believe our goal is to empower the reader with good analysis and good information. We do have specific recommendations that you can pick up the phone and call your broker and act on. We're doing very well in that regard. But sometimes people just want to, as I said, get the information and maybe do some other trade, and we welcome that. That's up to you. We're just trying to empower the readers with good information and good analysis.
Let's see here. Will the DPEG increase the value of the U.S. dollar? I feel like we've answered that.
Is this, someone says, where do I think when will the Canadian loonie go back up? Well, it'll be like every other asset. The Canadian loonie will go up when the U.S. dollar goes down. When will that be? It'll be when Janet Yellen gets her wake-up call. Probably not until late this year. I don't see it in the next 6 months. I think things could start to turn around. The dollar will get weaker out of desperation with weakness in the U.S. economy. Probably by September.
Another reader just asked, why wouldn't you just give away the one recommendation in our report that we're trying to get in readers' hands today? Why don't we just give it away for free on the call? Let's just be candid. I mean,
sure,
we give this away.
The reason is we don't like to make any recommendations without giving the analysis and the history and the facts. That's what the impact method is. So anyone can say, "Oh, buy this, buy that." I mean, that's what Bill Gross does on CNBC. We don't do that. We give you a lot of background, a lot of analysis. If you act on our recommendation, we want you to understand why. We want you to understand the background of it. So we want you to have the full report. So yes, the specific recommendation is there. You'll get one every 2 weeks from now on. You can look back at the archives. But we don't just throw tickers out there. What we offer is analysis, thinking, facts, trying to empower the reader. That's why.
All right, a couple of notes, but I want to get to Leslie's question from Katie. First, I'm getting messages. My team is IMing me here on my laptop here, so they're saying the lines are full right now. So there's a number on your screen to call to try Currency Wars Alert risk-free. We're giving you a special price tonight, 2 extra months for free. Plus, you're getting the trade recommendation right away that Jim believes you can use to make 300% when the Saudis depeg. And I think you made a pretty good case that people have to be in before it happens because you can't react afterwards.
The move will be so big when it happens, it'll be too late. You've got to get in now.
So if you're calling and the lines are full, please keep trying. Or there's also a button on your screen. Please click that because if you're just trying to get access to Jim's work, the button will do just as well as the phone lines. The phone lines will only give you the benefit of being able to speak to a live person. We have a team standing by in Baltimore. So please keep trying both. But this is a one-time opportunity, so I don't want you to miss it. Leslie asks an important question. I have never traded a stock, she says, and I wouldn't even know how to set up an account or get started. Do you ever help someone like me that doesn't even know where to get started? This is scary to me, but I might be willing to try if someone holds my hand while I do it. Or would you manage my money for me? I could invest $1,000, but I don't know if the subscription would really benefit me.
Right. Well, we're not. We're giving a recommendation service. We work hard to come up with our recommendations, but we're not a wealth manager. We're not an investment advisor. But there are plenty of them out there. You do have to be careful. But if you call one of the large, what we used to call wirehouses, so again, we're not recommending a specific broker, but whether it's Charles Schwab or E-Trade or Merrill Lynch, these are all very reputable firms, and they make it very easy for you to open an account. You can just wire the money from your bank account to your brokerage account, still your money. You don't have to do a trade, but if you want to, they'll help you do that. So the people who will walk you through the process and hold your hand are the registered representatives, the securities brokers, and you can find them at some of the names I mentioned.
Yeah, and that said, we also have in the Currency Wars Trader Handbook. I mean, we don't recommend any brokerages, and we don't We don't make personalized investment advice. We never do that. We're financial publishers. But we do give mock examples of how to place trades, and you can learn a lot from those. We break down some terminology for you. I think you'd climb the learning curve pretty quickly. That said, we should be pretty candid. I mean,
Sure.
you shouldn't, if you only have the retirement money and you're relying on this money, you should not.
Look, if you have $5,000 to your name, don't go into this trade. Keep it in cash. Like if you have $500,000 or $1 million, maybe if you have $50,000 and you want to put a couple $1,000s in the trade, that's the right order of magnitude. But you don't go all in on anything. I don't care if it's our recommendation, any asset class. Never go all in on any one thing. And candidly, if you just have a few $1,000s in the bank, hang on to the cash. This is not for you. But for those, we have a lot of our readers are what we call what's called the millionaire next door, and this is not necessarily a hedge fund maven or some securities billionaire. These are hardworking Americans. Could be a pizza parlor operator, a car dealer, a dry cleaner. If you have one of those businesses and you work hard at it for 20 or 30 years, you probably have a couple $1 million in the bank, but it doesn't mean you know much about financial management. You know your business. You know how to sell cars or dry cleaning or pizzas or whatever the case may be. So that's what we're here for, to help people who have a lot of money or a significant amount of money to invest. They're worried about losing it, and they should be. They'd like to make more, and that's a good motivation. They don't feel they can trust Wall Street, but they're not financial experts themselves. That's the audience we're trying to serve.
I took notes as I've been going through here, and I have kind of shorthand. There's three things that I think maybe a reader's wondering right now. And I'll just take the answers. What happens if Currency Wars Alert isn't right for me? And I think that's a fair question.
Sure.
In which case, I think that the offer we've set up makes it risk-free for you. You can subscribe tonight at an all-time low price, and you get 60 days, 2 months for free, basically. You get to just test drive it. You get to read our recommendations, look at our portfolio, test some of the trades, either put real money in or paper trade them, just follow them along, on a piece of paper. You get to see what we're all about. It's open kimono, right? And you decide if we're the real deal or not. If we're not, you can just ask us for a refund.
Sure.
We do hold back 10%, but we feel that's pretty fair because we do get pirates who come in, raid the whole portfolio, and they pay nothing. And that's not fair to the people who do pay and stick with us.
That's right.
All right, another question you may be asking. Can I get my money back? I think I answered that. Again, it's a 10% withholding fee, but otherwise it's a full refund before 60 days. So I think that's pretty fair. And I want to make it clear that this special price point, $1,750, it's a lot of money, but it's a great value given what we're delivering on.
Well, look, it sounds like a lot of money, but it's relatively inexpensive compared to a lot of research services that are out there that are tens and $20,000 and $30,000 or even more. There are $100,000 research services out there, number one. Number two, you can make that money back in one trade.
Yeah, hopefully the Saudi depegging trade. So
exactly.
And look, we're willing to send you the report for free tonight, but this is a one-time offer. Right? After 24 hours, what we plan to do is shut down this broadcast. So we're only going to be showing it for the next 24 hours. So if you joined us in the middle, you can rewatch it soon after we finish tonight. But I mean, this is a one-time deal that we're doing. It's a special offer. If you don't get in tonight, we're going to pull the offer altogether, so we won't be taking new subscribers to Currency Wars Alert for a while. But when we do, we're going to start charging $2,000 again, and that's for 12 months, and there's not necessarily a special guarantee where you get to test drive and get a 90% refund. So, I think we've kind of made a strong case for the Saudis depegging soon.
Right.
And that we have a good track record and a good method. And I think we've made a no-brain offer for readers.
Sure, and Turkey is a good way to play it, and it's a safe way in the sense that buying put options gives you a lot of upside. It has embedded leverage, but very limited downside. That's the way we like to do it.
So we kind of stand at a crossroads here. I'll let you put it in your own words. A reader's sitting there and he has a decision. I take you up on this or I don't. How do you put both options to them?
You should basically take us up on it for the following reason. We're going to offer you, we've got one idea on the table. You get that right away. You get the archives, which you can look at, and there might be a lot, actually there are a lot of ideas there. Some of them are a little dated, but some of them are still timely. But you're going to get a new issue every 2 weeks. So you're going to get a continuous stream. I write it, I research it. We do have a research assistant that I work with, Dan Amos, who's great, by the way. We put our heads together on the specific trading recommendations. But I travel all over the world. I meet with central bank governors. I meet with leading economists. I meet going to Washington next week to meet with a group of high policy officials who are something called the Center for Sanctions and Illicit Finance. You can go online and find it. I'm on the board of advisors. This is the inside group in Washington. We're going to be in a private conclave talking about the latest on sanctions. Sanctions have a big impact. So I take all these sources of information, my central bank contacts, my economic contacts, academics, think tankers, government officials, plus all the other information we get, market information. We bring all that to the table. I apply my experience, and we put out recommendations for you. And again, $17.50 sounds like a lot of money, but you can make it back on one trade, and you're going to get a trade every 2 weeks for the next year, or actually more than a year, 14 months. So it's a way. Look, Wall Street's out to get your money. The stock market's going down. World Bank of Scotland the other day said sell everything. There's always something to do, and that's our service. There's always something to do. But you know what? Maybe it is time to get out of the stock market. But there are things to buy, and we recommend them in Currency Wars Alert.
So let's wrap up here. This is a one-time event that we're doing, and it's a pretty urgent opportunity.
Right.
So if we could do a 30-second sum up, starting from the top.
Main thing is act now, act immediately, because the Saudis could depeg tomorrow. They could depeg in a few hours. They're waking up in Saudi Arabia in just a few hours, and the government could say, you know what, we're going to save our dollars to defend ourselves against Iran and break the peg. When that happens, the trade's gone. So I would act immediately, number one. Number two, it's not a one-shot deal. It's a relationship. You'll be getting this every 2 weeks. Three, sounds expensive. It actually isn't. This is cheap compared to the research services that I use. And you can make your money back on one trade. And we're going to give you 24 trades, actually more than that, because this is going to go on for 14 months. And we want to build a relationship with the reader, a relationship of trust. So that's really what we're offering.
Yep. We'd like to start that relationship tonight by sending you the new report that you just worked on. It's called The Great Currency Shock of 2016, and we'll send it to you right away when you respond to us. There's a button on your screen and also a number. That telephone number is 866-361-7662. And this is our team who are standing by in Baltimore. They're going to pick up your call when you call in, and they're going to walk you through any questions you have. But this is a one-time opportunity. For $17.50, you get 14 months of Currency Wars Alert. That's 24 specific recommendations from Jim, plus the report tonight, which outlines the specific opportunity around the Saudi depegging, plus the Currency Wars Trader Handbook, which that alone is really worth the money, because you give away your method and how to trade options. If you're a smart individual and you read that,
sure,
you kind of go out, watch the markets. And
we consider giving people the toolkit so they can make their own decisions, make their own smart decisions.
Right. So you not only get that, but you also get the archive to all of our previous recommendations, many of which are still open and good.
Yep.
So this is a one-time opportunity. I really do want to encourage you to click on the button or call that number. Otherwise, I just want to thank you, Jim, and
thank you, Peter.
really
Great.
forward to speaking
Thank
with
the audience
readers.
for tuning in.
All right. Thanks very much.